Question number 77 from revenue. First, we read the requirement as usual, and it says that identify whether the contract will be recognized as a contract asset or a liability, and what the carrying amount will be in the statement of financial position for 31st December. So first, you should remember what is contract asset. So contract asset, let me explain you, and then I will tell you that what do we exactly mean by that contract asset. It says Confidence Company entered into a contract on 1st January to build a factory. The total contract revenue was 2.8 million. It's a fixed value contract. So at 31st December, the contract was certified as 35% complete. This is important figure for us. Cost incurred during the year was 740, and the cost to complete are estimated at 1.4 million. 700,000 has been billed to the customer, but not yet paid. Actually, the 700,000 is your receivable, contract receivable. Contract asset is the amount which you can consider it as your accrued income, which you have earned but not yet invoiced. So contract asset will be, the uninvoiced work, the work which has been certified, which has been approved, which is your accrued income, but you have not invoiced for that. So whatever you should do in revenue, the first thing is always that you calculate, you go back and see how much is your contract profit. Always first find out the contract profit. So you have that revenue, the total contract revenue, we will say contract revenue. It should be like 2.8 million. Let's call it 2,800. And then you have contract costs. And within contract costs, you have two numbers. One number was incurred so far, and one are the expected. Okay, these two numbers you have to see. So incurred so far, what you have spent is 740,000, and you expect that you will further spend 1.4 million. So this is your total cost of the contract. When you make a total, you will come to a number of 660,000. This is actually your expected profit. Now, why do we need this number? Because we said that some part of the contract we already have finished. So what we have completed so far, it says that you have completed so far 35%. So it means that the total profit, out of the total profit, 35% of the profit you can recognize. Okay, so 231,000. This is the number which you can recognize because your total contract profit is 660. 35% of the work has been done, so 35% of the profit can be recognized. And now you say that costs incurred. So what you have incurred so far, costs incurred so far are 740,000. You put here 740, this you already have spent. And then you would say that, revenue recognized. The revenue which you are going to recognize is 231. So this is the total amount of your receivable, actually, 971. And out of 9, because the cost which you incurred plus the profit which you recognize, this is your total amount, which is your accrued income. Out of that, already invoiced. From that amount, you already have given an invoice, which is, I think, 700,000. It says 700 you have already billed. So you subtract this number. This 271 is called your contract asset. So this is the accrued income. This is the amount which you have earned but not yet invoiced to the client. You call it contract asset. 271,000 should be your answer. Now let's start reading this second question, which is, let me drag it a little bit down, which says, question number 79. Let's read it together. And it says, what is the profit to date on the contract at 31st March 2003? Okay. So on 1st October 2002, Pricewell Company entered into a contract to construct a bridge over a river. The total contract revenue was 50 million. Again, it is a fixed value contract. Most of the times here they are giving you fixed value contract. Sometimes they are, cost plus 10%. So whatever is the cost, 10% of that. But here these are fixed price contracts. And construction is expected to be completed on September 30th, 2004. So it is a 2 years time period. And we are talking about on 31st of March 2003. So 6 months have gone. Material, labor and overheads so far 12 million. Specialist plant acquired on 1st October 2002. It is 8 million. The sales value of the work done at 31st March has been agreed at 22 million. And the estimated cost to complete excluding plant depreciation is 10 million. So excluding the depreciation of this plant. The specialist plant will have no residual value at the end of the contract and should be depreciated on monthly basis. So we got this on 1st October and we are talking about 31st March 2003, October, November, December, January, February, March. 6 months, depreciation we should charge. Life is generally speaking 2 years because 2 years contract. Pricewell company recognizes satisfaction of performance obligation on the percentage of completion basis as determined by the agreed work to date compared to the total contract price. And agreed is 22 million out of 50 million work. So this is what we have done so far. And they ask you what profit you should recognize. So you should first calculate how much revenue is there and how much is, the cost, and then you come up to the profit. So let's first make the profit statement of this contract. We say our revenue, let me call it contract revenue. Contract revenue, which we have agreed is 50 million. And our costs, how do you identify the cost? You would say that incurred so far, this is 12 million. And then it says a further cost of 10 million, further cost, which you will recognize would be 10 million. And then all of this equipment, specialized equipment, it will be totally depreciated during the contract. So all of that. So I would say that specialized equipment, this is 8 million. So this is your, working for contract profit. So you can say that expected profit from the contract, expected profit is 20 million. Now 20 million is your expected profit, and then we say degree of completion. So, but we cannot recognize all of this 20 million now because we have just worked 6 months and we have just partially finished the contract. So you can partially recognize the revenue. He's asking you what is the profit to date. So you need to see how much work you have completed. So they say that it said that the Pricewell company recognizes satisfaction performance of obligation on the percentage of completion basis. So what is the percentage completion? Percentage completion is 22 million of work out of a 50 million of revenue. So this is your proportion you are going to use. So you would say that contract profit to date, which means until 31st of March, it will be your total profit is 20 million multiplied by 22 divided by 50. This 2250 is your proportion of work done. So you can say that you recognize profit as 8.8 million, which should be answer choice A. 8.8 million should be your contract profit to date. Okay, next is question number 80. Again, as usual, we talk about what amount should be recognized in the statement of financial position. Now we are not talking about income statement as a contract asset. Now you remember we did question number 78 also. Contract asset means that the amount which you have, the work which you have done but not invoiced. So it is actually uninvoiced work. So you need to find out how much work you have done, how much you have invoiced. The difference will go to the contract asset. So again, the same way we should start with that we start making our working for what is the contract revenue, how much we should invoice, how much we did invoice, and the difference will be called contract asset. So let's start reading the question. The following details apply to a contract where performance obligations are satisfied over time at 31st December. Total contract revenue 120, cost to date 48, estimate cost to completion 48, amounts invoiced 50,400. The contract is agreed to be 45% complete at 31st December 2005. What amount, and this 45% will help you to calculate your profitability. Okay, you will see how much is the total profit, and 45% of that you will recognize. So first, again, we find out our contract profit just like we did before in question number 78. So you should say that contract profit you will calculate like, your contract revenue, which is 120,000, and then you have costs incurred, which are 48,000, and then you would say that costs expected, the future costs will be 48,000, and this naturally will give you your contract profit. So this is your expected profit of the contract, which is 24,000, and you say, degree of completion, which is I think 45%. So it means that 45% of the profit can be recognized, which is 10,800 profit you can recognize. Now you come back and see what you have done. You say cost incurred so far is 48,000 and profit to be recognized. How much profit you should be recognizing? This is 10,800. So it looks like that this is the value, this is the amount of work you have done, this is something you expect, this is your total receivable. And you would say invoiced amount. How much you already have invoiced out of that? So they gave you 50,400, you already have invoiced. So you say minus 5,400. So here minus 50,400, and the difference of this is the uninvoiced amount, 8,400, or you can call it 8.4 million. This is your contract asset. I repeat it again, contract asset is that amount which you have already earned or worked, but you have not invoiced. So the total value of work done or the amount which you are expecting is 58. It includes your cost plus 45% of profit. So this is 45% of total profit, okay? Because you finished 45% of the job. But what you have invoiced is 50,400. So this goes into my actually receivable, and this is my accrued income, but this is also kind of receivable. It will be invoiced in next period. 8,400,000. This is your contract asset amount. Okay, so this is done. Let's clear it. These are short, simple questions, but they are important. I mean, you do get questions like this in exam, these short questions, and they are actually your bonus marks in exam. Question number 81. It says, what amount of income, not profit, income will be recognized in respect of the grant? Okay, this is from government grants. Let's skip this question for a while, and we are doing revenue question. Let's find out another question from revenue. Okay, let's do this 82. It's again from revenue. Again, like we always do, first read the requirement. Identify whether a contract asset or a contract liability should be recognized, and at what carrying amount in the statement of financial position. Very similar to question number 78 or 79, but let's start reading it. It said Springthorpe Company entered into a 3-year contract on 1st January 2002 to build a factory. This is a contract where performance obligations are satisfied over time. The percentage of performance obligations satisfied is measured according to the certificates issued by surveyor. The contract price was 12 million At 31st December 2002, which means exactly after 1 year, details of the contract were as follows. Cost to date 6 million, estimated to complete 9, so total cost will be 15. Already invoiced amount 4 million, certified complete completed work is 40%. So how much is contract asset? Again, 3 steps you have to do. Listen, very simple question. Whenever you get this contract asset thing, step number 1, you find out your contract profit first. Okay, contract profit you need to find out, and based on, okay, let me call it like this: total contract profit take. Then you take your percentage of profit on completed work. Then we found out our cost plus profit. This will give us work done. And then we find out how much is invoiced. So how much we already invoiced. And the balance is always your contract asset. This is like the third question we are doing, and we followed the same pattern. And we are going to follow the same pattern here again. We will find out that how much is our profitability from this contract. So let's first find out the contract revenue. I called it contract profit. How do you calculate contract profit? You say contract revenue. So how much we have agreed? Contract price was 12 million. So this is 12 million here. And then you say contract cost. And in this question, contract costs are very simple given. They told you contract costs are 6 plus 9. So that's going to be a loss. Okay, that's interesting. So this is what you expect. You expect a loss here. Okay, so when you see a loss, what do you do? When you see a loss, what do you do? Okay, now please, you need to pay attention. I will write down one sentence. Profits we accrue and split over time. Losses are recognized immediately. And this is the concept of prudence which we are using. Listen, what does that mean? I will do this question later. First, you understand the concept. Let's suppose that there is a contract. Let's suppose it's a very simple straight contract which gives which has a 3 years life and 3 million profit. So total profit is 3 million, total life is 3 years. Let's suppose a very straight calculations. So what will happen that 3 million profit over a period of 3-year time, you recognize profit year by year, 1 million, 1 million, 1 year. So profits, we said that we accrue and split over time, but losses you do not. Now let's suppose that you have a big contract which has 3 years life, and you expect that your total loss will be 3 million. So contract will continue in 2010, 2011, 2012. In 2011, here you identify, you estimate, you realize, you calculate that this project is going to end up in 3 million loss. So you identify this in 2011. So total loss will be 3 million and the contract still has 2 years life. Should we do it 1.5 million, 1.5 million loss here, like minus 1500 and minus 1500? I mean, should we split the loss over 2 years? Answer is no. Whenever you identify, whenever you see that there is a loss, you cannot carry forward the loss. You cannot transfer the loss to the past, to the future period. You calculate it today, you immediately recognize it today. There is no option available to you which, by which you can just carry forward some loss. Okay, half of the loss I recognize this year and half of the loss I recognize next year. It cannot happen. If there is a loss, it must be recognized immediately. This is what I said, that profits we accrue and split over time, losses are recognized immediately. So based on this, now we've got this loss of 3 million. We cannot say that, okay, we have done the 40%. If we had a profit of this, let's suppose we had a profit of 3 million, what you would have done? You would have taken 40% of the profit only. You would say that work is 40% complete, so I will take 40% of the profit. But it is not profit, it is loss. And you cannot take 40% full. All of that loss must be treated immediately. You cannot take loss on proportionate basis. Okay. So this is important to understand and remember. So what you should say now, you should say that costs incurred, just like we were doing before. How much cost we have incurred so far? Cost to date are 6 million. And losses, you've got loss of minus 3 million. And how much you invoiced? You remember you always subtracted the invoiced amount. So amount invoiced is 4 million. 4 million you already have invoiced. So now when you make a total of these numbers, it gives you -1. So you've got not a contract asset. In fact, you've got a contract liability here. So that's a contract liability of coming up of, 1 million. That's a contract which is in loss. You've got 1 million contract in liability. So asset or liability or carrying amount, I would say that it is a contract liability, and it should be like this: contract liability with $1 million. So don't think that it is like this. Okay, it is not like this. There is no relationship. This is a separate column, this is a separate column. It's a liability and it is 1 million. Okay, this is now 83. Again, let's first read the requirement. It says, according to IFRS 15, revenue from contracts with customers, how should Cambridge Company record this transaction in its financial statements for the year ended 30th June 2009? Revenue, current liability, and trade receivable. We have to pick up these numbers. Okay, let's start reading the question. How much is revenue? How much is current liability? How much is receivable? On 25th of June 2009, Cambridge Company received an order from a new customer, Circus Company, for products with a sales value of 900,000. Circus Company enclosed a deposit with the order of $90,000. So it looks like that the customer is giving you 10% in advance. So when you receive advance, it is actually a liability on 25th of June. So far, this is your deferred income, advance income. It is your liability. On 30th June, like 5 days later, Cambridge Company had not completed credit checks on Circus Company and had not dispatched any goods. So they received the money, but they actually have not yet agreed or decided to supply the goods, because the customer is paying 10% advance and 90% would be receivable. And before giving a credit of 810,000, this credit company wants to do the credit checks, and those have not been done. According to IFRS 15 revenue from contracts with customers, how should Cambridge Company record this transaction in its financial statements for the year ended 30th June 2009? Select your answers from the options available. Options may be used more than once, and all 3 amount boxes must be completed. So revenue, of course, there should be no revenue. Current liability is, of course, there is current liability of 90,000. And trade receivables, again, nothing. It is also nothing, because you have received the order, you have received the money, and this cash is like a liability on you. You have not delivered the goods, you have not delivered any performance obligation, no revenue, no receivable, just a liability of $90,000. Okay, number 84. Repro Company, a company which sells photocopy equipment, has prepared its draft financial statements for the year ended 30th September 2004. It has included the following transactions in revenue at the stated amounts below. Which of these have been or has been correctly recorded in revenue according to IFRS 15? So which one? So there is only one which should be correct. So agency sales of 250,000 on which Repro Company is entitled to a commission. So they have actually revenue included in revenue. This is agency sales. Agency sales, you cannot add into your revenue amount, okay? I mean, you cannot add 250,000 in your revenue. So agency sales is like that there is a parent company and then there is a distributor company. This distributor company is selling goods to the customers and receiving the full amount. So customer pays you 100, but you have a 10% profit, 10% commission there. So this distributor company cannot record $100. They only record 10% of that, okay? So 10% of that should go into the revenue. They should not be saying 100. So sometime what do they do? A very common mistake is that they say that, okay, I will record my revenue as 100. And because I have a 10% markup, so $90 they record in cost of sales, which is not a proper treatment. So what do? They say that 100 I receive, I put straight 100 into my revenue. And because I'm entitled to 10%, so 90% is my cost, and they start charging $90 into cost of sales so that they come up to a number of $10, which is not a proper treatment. Actually, you should only be taking 10% of that into your revenue. So this is wrong because it was not their revenue. It was the revenue of P company. They were just selling on behalf of P. So it is not their revenue. Their revenue is only 10%. B, sales proceeds of $20,000 for motor vehicles which were no longer required by repro company. So again, it is a disposal of non-current assets. You sold a non-current asset. You cannot take it into your revenue, okay? So when you sell a non-current asset, any gain or loss which you make, that goes to income statement and it should be shown in other income part below the gross profit, other income, the difference between the net book value and the sale value. But it should never, and they are putting actually sale proceed, all 20,000. First of all of this 20,000 will not come. All of this 20,000 will go to the cash flow statement. In cash flow statement, you will write down under investing activities, all this 20,000 as cash inflow. In income statement, you will not show the proceed. Proceed means the total cash coming in. In income statement, you will only write down the profit part, the gain. Like if net book value was to 19, they sold it for 20, 1,000 will go to other income. But nothing should go into revenue. Revenue, you cannot write down anything because revenue is only from your core activities. Selling non-current asset is not core activity. This is wrong. C, sales of 150,000 on 30th September. The amount invoiced to and received from the customer was 180. So customer paid sales 180, which included 30,000 for ongoing servicing work to be done by repro company over the next 2 years. So they sales of 150,000. The amount invoiced and received from the customer was 180, which included 30,000 this ongoing service work to be done this much. Okay. So that actually is the correct answer because they received 180, but within 180, 30,000 is for future. So this is deferred income. Your revenue should only be 150 and they are recording 150. So they are doing good. So the customer paid 180,000, but they did not take 180 full in the sales revenue because 180, 30,000 is for future servicing and they excluded that 30 and only showed 150. So that's a proper treatment. If they record all 180, that would also have been wrong because that is not the revenue. This is deferred income. This revenue will be earned in future. If I understand what they have done in this double entry, they have said debit, cash or bank, whatever. This is what they have done, 180, and they said credit revenue 150, and they should say, and they did it like this, credit, deferred income 30. This is what they did, and this is what they should have done. So option number C looks correct. Let's first read D also. Sales of 200,000 on 1st October 2003 to an established customer, which with the agreement of repro will be paid in full on 30th September. Repro company has a cost of capital of 10%. So they have sold goods and they are putting 200,000 straight into their revenue again, which is not correct because it will pay you after 2 years. So if you remember that significant financing component, when they are making a payment after 2 years, the revenue should be actually only, how to say, the discounted value, the present value. If you ask me how much revenue they should have recorded, they should have recorded revenue as 200,000 divided by discount factor 1.1 and power 2, 2-year discounted value. So for this particular transaction, where was it? The revenue would be here. For this particular transaction, the revenue amount would have been or should have been only 165,000. The remaining 35,000 thing is actually financing component, because customer said I will pay after 2 years. So there is some credit time value of money component. So this also is wrong because they cannot treat 200,000 into the revenue. Sales are to the, because you have to separate the financing component.